Hey everyone, welcome back to another episode of AWM Insights. Justin Dyer here, Chief Investment Officer at AWM, joined as always by Mena Hanna, our portfolio manager here at AWM. And we're going to continue to just talk about the plethora, the long list of events going on in the world today. And a lot of them are not funny, so I shouldn't be chuckling. However, we want to change the narrative or the discussion that we really focus on today to the simple question of, hey, am I safe, right? There's a lot of volatility. There's a lot of serious events that are going on, but we want to really distill it down and speak a little bit more tangibly about how to think about you, your portfolio, your family. Are you protected? We've mentioned it. We've touched on it over the last few weeks, but we're going to expand on that quite a bit. I do want to say, kind of just preface this, that Mena and I were chatting ahead of time and trying to figure out what to talk about today. And we struggle with it because we are comfortable. We're so comfortable with our approach during times of stress that we don't want to just repeat ourselves. We want to actually give you all listeners a new takeaway, a new way of thinking about investing, a new way of understanding how we think about investing. And so we didn't just want to say, oh, hey, there's crazy events going on. Don't worry, there's going to be volatility. You're fine, right? Like, we want to add to that. We want to add some substance to that general conversation. So without further ado, we're going to try to do that today. Mena, let's start kind of with first principle. I think it's always good to go there. Like, when I talk about digesting how to think about your own portfolio today, what is going on today, right? I assume this is going to be repetitive to folks, but we also want to make sure we're all on the same page. So yeah, what are we seeing?
There's a lot of turbulence. There's a lot of turbulence in a lot of different markets too, which is sometimes rare to have kind of a major weather storm across, call it a large portion of the investment universe. Public equities, obviously, and this is internationally because of the geopolitical issues of today, that it's impacting every single economy, whether it be the European economy, the American economy, the Asian economy. We're seeing turbulence in public markets across the board. We're also seeing turbulence in commodities. Oil is the big one. Supply chain's been massively disrupted. We talked about that already, but that also influences public markets and also private markets. And then we're seeing some turbulence in private credit, to be specific. That doesn't have anything to do with kind of the geopolitical events of today. It's more of a structural issue and kind of one of the reasons that we haven't wanted to invest in private credit in general, and it's an asset class we don't have exposure to. But yeah, just a lot of turbulence going on in a lot of different asset classes for various reasons.
Yeah, right. Various reasons. It's geopolitical to structural with private credit to, let's call it market dynamics with respect to AI and people still questioning whether there's a bubble or what's the impact of that crazy technology. So yeah, lots going on, right? Which again, I think we all know. But where I'd like to take the conversation is, given that backdrop, let's go back to the building blocks. This conversation we had a few months ago, kind of going through how we build portfolios, and did that whole series about the foundation, the offensive line, your defense, like first and foremost, those are most important. Let's go there. How do we think about it? Why is it important? These are all tailored to our clients, their situations. And I think contrast that or compare it to what is most common out there, kind of the more cookie cutter approach.
Yeah. And it's never fun to log into your portfolio or log into Schwab or Addepar and see that your investment portfolio is down. But the way that I like to think about it is, am I actually going to be okay? Is the core of my portfolio, the defensive part of my portfolio, robust enough to take care of me and to make sure that I don't have any, call it, changes that I need to make for either the short, intermediate, or long term? That's kind of where I like to start off. Again, never fun to see see your net worth on paper go down, but I'm ultimately at peace because, and kind of highlighting what you said at the start of the call, our process is so robust. The defense is there. The defense is there, especially in times like this, where the question, am I going to be okay, is easily answered with a yes. There's a thoughtful approach that carries any of our clients through multiple years of full spending. So there's definitely a safety net built into how we structure and how we build out portfolios. And kind of shamelessly plugging the 2001 Miami Hurricanes, that team would have gone 8-4 if their offense scored 0 points. So when we really talk about winning championships and winning championships and building this 100-year family, 100-year dynasty, you need a good defense to do that. You can't have a defense that's subpar, that's going to bleed points when you need them to be structurally solid. So that's why I hope our fixed income portfolios is as good as the 2001 Hurricanes, but that is how you win championships, and that's how you are resilient in times like this. You brought up the cookie cutter example and how people really manage money, and we see this a lot of times with athlete portfolios that are coming in, is just that small, medium, and large shirt size that financial advisors give to their clients, and they hope that the fit is good enough and it's okay. And there's a lot of slop with that, especially in times like this. You can get really, really hurt. We saw this in 2022, where some fixed income strategies were down 20+%, and your equities were down roughly 18%. So your safe money lost more money than your aggressive money, which we hate to see. But that's what happens when you're not thoughtful with how you build out portfolios. And in times like that, your hands are sort of tied behind your back. You're either not doing what you want to do in life, you're not buying a house, you're not buying a car that you've previously planned on because you don't want to take a 20% loss, or you take the 20% loss and destroy money and destroy wealth forever. So we want to make sure that we put our clients in a position where they have a pool of fixed income that's short term, that doesn't really move with the market, that's there for them when they need it, even when markets aren't doing so hot.
Yeah, I think that's incredibly well said, right? And in a way, the common application to building portfolios, take the cookie cutter approach. You put 60% in stocks, 40% in bonds, or some percentage of that, right? Ratchet it up 10% either way. On the fixed income side, that is really what is most important, and kind of what you're getting at is it's risk masquerading as quote unquote diversification. So many people build portfolios like that and you're like, oh, you're diversified because you have 30% of your assets in fixed income or bonds. But then within that bond portfolio, there's a whole heck of a lot of risk that will move, or just there's a whole heck of a lot of investments that will move in the exact opposite direction that you need right when you happen to need it. So I think that is the most important point here to walk away from, or walk away with, right? Exactly what you just said. To win the championship, to build the 100-year family, to build that dynasty, you need that defense. That defense and the defense and or foundation, right? We could talk about the foundation of a home, which we talked about in past episodes. It starts with a, arguably plain and boring fixed income approach, but that's tailored exactly to your priorities. It's precise versus just some sort of approximate type allocation or type dollar amount that you're putting in fixed income. Whether that's actually the right type of fixed income or not is a whole nother question, and usually it is not, and that's what we see in periods of time like this. It really can destroy wealth if it's not well thought out. And so I think those are really important takeaways that I certainly want to highlight and kind of underscore with what you said.
Yeah, and it is scary to see your portfolio move, but it's also scary to see every single asset in your portfolio move in the wrong way. So that's what we want to make sure that we move against. And yeah, this is kind of a situation where there's and a lot of ways in which these portfolios are built, there's very little to gain, but there is a ton to lose. So when you
if you overreact.
If you overreact
or
and
not precise in your construction.
Not precise in your construction. So if you really are not thoughtful here, there is massive downside with not a whole lot of upside.
I also want to make sure we do remind everyone to take a step back and also think about long term, right? Yes, markets are incredibly volatile right now. It is uncomfortable. It's human nature. That is totally normal. Ask us questions. Hopefully these conversations help listeners just digest it all in the correct way. But markets, aren't down negative across the board so far this year. Believe it or not, emerging markets, just looking at this, or really ex-US, non-US markets are still slightly positive for the year. US markets are negative, low single digits. But extend that to the last 12 months. We're still up. You extend that even beyond that, you're still up. Now, obviously, that applies to folks that have been invested, but it's just a good reminder, right? The 100-year family takes that perspective, takes that discipline. Yes, we need to understand what's going on in current market environments, digest that, stress test our thinking, all that good stuff. But the 100-year family is exactly that, 100-year, very long-term. Discipline is critical, and to get there, defense will really, save the day, if you will. So,
one thing that I also want to hit on is just looking at our portfolios and our equity portfolios in particular. There's a lot of diversification here that is going to help in times like this. You mentioned emerging markets. Emerging markets are still up on the year, which is great to see. Real estate as well, publicly traded real estate, that has actually been doing extremely well this year. So when you're putting that offense together, you have to make sure that you have exposure to all of these different asset classes. And at the same time too, this was actually a client question, or client point, I hate paying $15 more at the pump when I'm filling up my car with gas. Well, you actually own probably a little bit of that company that's now making more money off of you. Now, kind of not fun to get money made off of you, but at the end of the day, that actually shows up in their profits, that shows up in their stock price. I actually sent them how much of Chevron they own. And it's a much more significant amount of money than the $15 extra that you're paying at the pump. So that money obviously comes back into the portfolio via dividends or via just share growth and expansion. But it's important to remember that as a client of AWM, you are invested in the global economy. And even when prices move up on some things, you're probably participating in that growth in some way, one way, shape, or another.
Yeah, that's a great place to end, and just great perspective, right? It's in times like this where there's a lot of uncertainty, not only domestically, but just very broadly around the world. One of the best places to, or best approaches to take is really diversification. There is a lot going on, so please let us know if you have any specific questions.
626-862-0355.
Shoot us a text. We love talking about things that are top of mind, relevant, very specific to you all, our listeners. And most importantly, know that our process is precise, right? It gives you the protection you need to withstand bouts of volatility. We don't know how long this period will last, but we know there's a process in place to build and support that 100-year family, and we love serving you all along that journey. So until next time, own your wealth, make an impact, and always be a pro.